All right, let's just get right into it because we have a huge puzzle on our hands. I mean, you look at all the data, everything from consumer debt to what companies are actually earning, and it is all flashing bright red. By any logical measure, the stock market should have already taken a nosedive, but it hasn't. It just keeps climbing. So, what on earth is going on?
And that is the big question we're tackling in this explainer. The thing is, the answer isn't just, oh, the market's gone crazy. No, it's actually being propped up by a couple of hidden forces. Forces that are basically just delaying the inevitable. And trust me, once you see what they are, the whole picture starts to make a pretty terrifying amount of sense.
Okay, so first, let's just look at the raw numbers, because honestly, they're kind of nuts. There's one indicator in particular, it's super simple but incredibly powerful, and right now it's screaming that we're in a massive bubble. Yeah, you've probably heard of him, Warren Buffett. He has this favorite tool for checking the market's temperature, and it's dead simple. He just looks at the total value of the entire stock market and compares it to the country's entire economic output, the GDP. It's a genius way to see if stock prices have just completely detached from the real-world economy. So, to give you some perspective here, right before the dot-com bubble burst back in '99, this indicator hit 115%. And back then, everyone thought that was crazy overvalued. The market then proceeded to crash by more than 60%. So, where are we today? We're sitting at 220%. We're not just in the danger zone, people. We are in completely uncharted, never-seen-this-before territory. So that's the big picture, right? The whole market. But things get even wilder when you zoom in on the individual companies that are really driving this thing. It all boils down to a simple question. How much are investors willing to pay for every dollar a company actually earns? This is what's called the price-to-earnings ratio, or PE. It basically tells you how many dollars you're paying for just $1 of a company's profit. Now, historically, a normal PE for the market is about 15. Today, we're almost double that. But check out the big tech stocks. Microsoft is at 35, Nvidia's at 53, and then you get to Tesla. Its PE is 286. Let that sink in. That means people are paying $286 for one single dollar of Tesla's profit. That's not investing, that's a level of speculation that's just completely off the charts. So you have to ask, why would anyone pay these insane prices? Well, it's not just random craziness. The truth is, the market's being held up by two really powerful connected forces that most people just don't see. So let's break them down. Okay, force number one is basically a kind of quiet, nonstop government stimulus. Those stimulus checks from a few years ago are long gone, but the government is still pumping a staggering amount of cash into the economy. Get this, it brings in about $5 trillion in taxes, but it spends $7 trillion. That $2 trillion difference, that annual deficit, that money props up corporate profits. And, you guessed it, the stock market. But with the national debt sitting at $38 trillion, you gotta ask, how long can that possibly go on? And that leads us right into the second force, the devaluation of the dollar. I mean, it's simple supply and demand, right? The more dollars that get printed, the less each one is worth. And here's the trick. Here's how that inflates stocks. A weaker dollar means companies can just raise their prices. This makes it look like their earnings are growing, even if they're actually selling less stuff. See? It's not real growth, it's just inflation dressed up as growth. And of course, as every dollar you hold buys less and less, where do you put your money to protect it? You pour it into assets, like stocks, which, surprise, pushes their prices even higher. And it's so important to understand who actually benefits from all this. The top 10% of the population, they own nearly 90% of all stocks. So when inflation jacks up asset prices, it's basically a giant wealth transfer machine. The people who own the assets, the rich, they get richer. And what about everyone else? Well, the bottom 90% just gets stuck with a higher cost of living. This isn't an accident, it's a feature of the system, not a bug. So here's the bottom line. These two forces can't go on forever. And this is key. Markets don't crash just because the economy is bad. They crash when confidence breaks. Think of it like a bridge that's got way too much weight on it. Right now, there are three main cables of confidence holding this whole thing up, and all three of them are starting to snap. All right, fraying thread number one. The consumer is completely topped out. I'm talking record low savings and record high credit card debt. That's just not sustainable. Second, the labor market is starting to crack. You're seeing more layoffs, more hiring freezes, and remember, employment is what they call a lagging indicator. It can look totally fine right up until it falls off a cliff.
And third, the Fed's go-to move of cutting interest rates, it's not going to be the silver bullet this time. You can't solve a massive debt problem by just making debt a little bit cheaper.
And this isn't just a feeling. We have hard data that shows confidence is already breaking. The University of Michigan's Consumer Sentiment Index, a really important measure, just plunged to near record lows. People are feeling the pain. They're losing faith in the economy. And when that confidence disappears, you know what goes right after it? Consumer spending.
And all of this leads into a classic cycle of, well, false confidence that you always see right before a market crash. Crashes feel like they come out of nowhere, but they're never really sudden. They're predictable. In fact, they almost always follow a three-phase pattern, a pattern that's already well underway as we speak. Okay, phase one. The market stays irrationally high for so long that a new normal sets in. People start saying, this time is different. Sound familiar? Yeah, we are deep in that phase. Phase two is what you could call crash fatigue. Investors just get bombarded with so much bad news that they become numb to it. It just doesn't move the needle anymore. And we are definitely there too. All of this just sets the stage perfectly for phase three, a single event, some kind of trigger that shatters confidence and causes a sudden panic where everyone tries to get out the door at the same time. And this is exactly why this delay is so dangerous. Think about it. Every single day, the market is held up by these artificial forces. The gap between its price and its real value gets wider and wider. That bridge gets more and more overloaded. So when it finally gives way, it doesn't just gently sag. No, it snaps back to reality violently. The longer the delay, the faster and harder the eventual fall.
Okay, so look, the point of all this isn't to be a doomsayer. It's about understanding the cycle so that you can keep your head on straight when everyone else is panicking. So let's pivot and talk about the practical, actionable things you can actually do to protect yourself.
First things first, build up your cash reserves. Having cash on hand is king. Second, if you are invested, focus on high-quality companies, the ones with low debt and real, consistent earnings. Third, and I can't stress this enough, avoid leverage. Do not borrow money to invest right now. It's just a recipe for disaster. Fourth, have a plan. Decide today what you will do when things get rocky, so you aren't making decisions based on fear. And finally, number 5, just keep learning. Keep educating yourself on what's really going on.
Because here's the secret that wealthy investors have always known. Market crashes create incredible opportunities. They are essentially a massive sale on assets. And the people who make fortunes in these moments are always the ones who were prepared, the ones who stayed calm, and most importantly, the ones who had cash ready to deploy when everyone else was selling in a panic.
So what's the big takeaway here? It's simple. By all logical metrics, the market should have corrected by now, but it's being propped up by temporary, unsustainable forces, and those forces are weakening. The day of reckoning hasn't been canceled, it's just been delayed. Or, to put it another way, the crash isn't canceled, it's queued. And now that you understand the hidden mechanics at work, you have a massive advantage, so use it wisely.